really talented developers, designers, entrepreneurs wanted to work on social and environmental issues, and they weren't getting the opportunity to do that. We found that some people certainly thought that BGV companies would have mission drift. As they get bigger, they'll care less about impact. What we found is actually the opposite. Impact investing, it was a bit in the helicopter position. It had been talked about in very high-level forums and all this stuff, but the implementation of impact investing was still very early. Impactful tech businesses will be the most valuable businesses of the future. The companies at the top of the stock market in 10, 15 years' time will be the ones that can really demonstrate they have a positive impact. The world is a Venn diagram of high growth, high profit, and high impact, and we're looking for the intersection between the two.
I really wanted to speak with you because you are based in London, but you're not from London. You are from England's second city. You're from Birmingham. You're a real live Brummie. And I wanted to hear that same accent that Shakespeare and Chaucer both spoke, and Ozzy Osbourne, you know? Yes.
Oh, Ozzy Osbourne, there's a true Brummie. Yeah, definitely. So I don't really have much of a Brummie accent anymore, I have to admit. I've lived in London for quite a long time. But yeah, I know I grew up in the Midlands, and a proud Brummie, but don't get to spend enough time there these days.
I've never been to Brum, but as long as I can remember, everyone's always taken the piss out of Birmingham. Why is that?
Well, I think the accent has a little bit to do with it, to be honest. But joking aside, Birmingham is a really interesting place, and I grew up there in a really interesting time as well, because it was really, I was born in the late 70s, and the 80s was the time when there was real industrial decline in Birmingham. It was obviously it was the birthplace of the Industrial Revolution, basically. But by the 1980s, there was real social change going on as those manufacturing jobs and so on just really, really started to decline. And to be honest, the UK became more centralised on London even than it had been before, partly because of the growth of financial services and the Big Bang and all that kind of stuff. So it was a really interesting time to be growing up in Birmingham, not always entirely positive, because it was, it definitely felt like a city that was fading a bit at the time. I think it's bounced back a lot recently, but the time that I was growing up, it had all kinds of problems.
So do you know any good Brummie jokes?
Now you're asking. I think it's all about Peaky Blinders now, which obviously wasn't a thing when I was growing up. But now everybody, whenever they sort of mention, Birmingham to me, they always mention Peaky Blinders, and I'm like, it's definitely not like Peaky Blinders.
All right, so I got one. I'm going to try it out on you, okay? People across the UK were asked which city they thought was the UK's second city. And people from Birmingham said Birmingham. People from Liverpool said Liverpool. People from Manchester said Manchester. And people from Stoke said London. All right, so that's enough of that. So yes, you grew up in Birmingham.
Yeah, it's interesting. I grew up in, I guess, middle class suburban household. My mum was a teacher, biology teacher, in public schools in the UK, and my dad was a civil servant. He was an engineer, but worked for the government for most of my childhood. And yeah, it's interesting. I think the one thing that really affected me, actually, only now do I realize that it was a bit of a different sort of childhood, was that actually I was exposed to quite a lot of social and environmental issues throughout my childhood, because both my parents were really interested in those kinds of things. My mum was actually really involved in campaigning. So she'd done a year teaching in Malawi when she was in her 20s, and so really learned about kind of developing countries and so on, and global justice was really part of her thinking. And then my dad was really interested in environmental issues. He was they were both quite involved in the church as well, and so things like asylum and refugees, and I had lots of exposure to those kinds of things, which I didn't think was unusual. I don't think at the time that just felt normal. But now I realise that actually I was really exposed to some a lot of the issues that I find myself working on day to day. And I realize I've been thinking about those things for 40 odd years. So that was what was different, I guess, about my upbringing.
But then when you left for university, you went off to the University of Nottingham, but studied physics. Why physics?
It's partly I had a really inspirational physics teacher when I was at school. He was definitely one of our best teachers, was a physics teacher. And I loved the way that he got us into physics. I think had a lasting effect and really made me fascinated by that. And then also I had an uncle who was a physics professor. And actually he was the person who really introduced me to, the first time I saw the internet was in the cupboard under his stairs at his house. He was a professor at the University of Edinburgh, and we went up to his house, and this was in the 80s, and he had one of those modems where you actually took the receiver of your phone and put it onto the modem.
Remember it well.
Yeah. Then you dialed a number in his case, to the university to connect to the internet, which was obviously almost entirely an academic network at that point. So that was the first time I saw the internet as well. So I think the physics connection came through family and school, and I always loved it. And then actually I realized when I got there that it was a really interesting time for physics. So when I was at university, the things that were starting to move ahead in physics were actually things like network theory. So all of the stuff that was going on around studying both technological and biological and social networks, that was really moving forward. So actually the cutting edge of physics was something that was very related to tech as well at the time. So I learned a huge amount about complexity and network science at university. That's, again, has stood me in pretty good stead, actually, later on in my career. After you got your bachelor's, went to Middlesex University for a master's of professional sustainable development. Explain what that is. It's a really interesting course. So it's actually run by an organization called Forum for the Future, who are an NGO, and they set up this program to take 12 students each year and to try and train them to be professionals in sustainability. So the idea was that they were training a generation of leaders who would go on to put sustainability into practice in all sorts of different fields, I guess. And the way it worked was you did 6 one-month work placements as part of your master's. Each placement was in a different sector. So I did one in local government, one in the European Commission. I did one with BP, just at the point when they were becoming beyond petroleum and all that kind of thing. One for an NGO called Fair Trade Foundation, and then one in the media as well. So, and they were, and then you reflected on those placements, and alongside that you had, tuition and around sustainability issues as well. Yeah, it was a fascinating course. They've actually stopped doing it now. They ran it for 20 years, taking 12 people, and there's a really strong alumni network behind it of all the people who ever did that program. It's a pretty strong network. Definitely some people in sustainable finance who you will come across who did that program as well. So, why do you suppose they stopped it? I mean, because now sustainability is the thing. I think partly because sustainability is the thing. When they were running the program, actually, it was very, very new, and I think a lot of the funders funded it because it was innovative and new and so on. And then it actually, we got to the point where some of these issues were much more mainstream, and people were like, well, does it need a special course? Surely this is now integrated into other things like MBAs and all those sorts of programs. So actually they got to the point where I think they felt there was less demand for a very specialist and innovative approach to it. And actually it was being absorbed a little bit more into mainstream education and learning programs. That was sponsored by Forum for the Future, but then it looks like when you completed the studies, then you actually were working for Forum of the Future as a policy advisor. Tell me about that. A couple of years of working actually mainly with tech companies to look at their sustainability, both from on a social and environmental side. So I did some work with Amazon at the time and Vodafone, those kind of companies who were very big in the early noughties. And it's interesting. I mean, at that point, none of those companies really had an approach to sustainability or CSR even yet. ESG certainly wasn't a phrase that was. This is in 2000. 2002, 2003 kind of time. And so a lot of what we were doing was introducing them to frameworks to start measuring things and to start seeing, okay, what is your impact in that space? But then also projecting forwards and saying, look, if you do keep on doing this, this is the impact that it might have over the long term. And we certainly, got a good hearing from senior management in those companies at the time. And I think we were really just putting it on the map for them. I wouldn't say that there was really senior level buy-in at the time to sustainability or social issues in those big tech companies. That's something that's changed over time, but back then it was just the start of the real tech boom, I guess.
And then in the early aughts, you went to a place called Demos. What led you to leave Forum for the Future and go to Demos? What is Demos and what did you do there? Yeah.
Demos is one of the most influential think tanks in the UK. They were created around in the early 90s. They became the place that drafted and thought a lot of the sort of policy ideas that came to then were put into practice by the new Labour government, so by Tony Blair and that group. And Demos, by the time I was there, was very much about kind of implementation and how do you take what's new and put that into practice in policy, not just in the UK. By that stage, we were working with governments and companies all around the world. And again, I came in at quite an interesting time when I think the tech boom was starting to take off in the aughts, and we were starting to work with tech companies and with governments to say, okay, hang on, look, if the majority of the population are online, which they weren't yet even back then, or if, this newfangled technology at the time that we called 3G, obviously it feels a bit back now, but it was,
I remember that.
Yeah. What happens if everybody has access to information on their phones, and so on. So we were working on some really interesting ideas, which seem completely mundane now, but at the time were, trying to get politicians to think, okay, well, how do we create policy that can take into account changes that are going to happen over the next 10, 15 years? It was a really interesting time. And I did a lot of work on actually disability and like how can technology affect the life chances and opportunities available to disabled people. And I think we genuinely started to get people in government to think about like accessibility of information, for example, about government in a new way, because technology was coming down the road that made that more possible. So, it was a really interesting time, and I've got sort of brilliant access to see like how government works and how some of the big companies work in terms of their policy and strategy making processes.
Then in 2006, you founded the School of Everything, and now that is a grand name and has a lot to live up to. What is the School of Everything? How did that come about?
So one thing I'd noticed in looking at tech this was about 2006 was you're starting to see, I guess, the growth of Web 2.0, as it was called at the time. And that was driven by there being more tools in the hands of developers, particularly things where you could actually prototype things very cheaply. So you didn't have to go out and buy your own servers for the first time. For example, Amazon Web Services and all that kind of thing was starting to come about. And basically noticed that the cost of starting a business was just starting to go down and down and down and down. And there was a point where I read something where people were saying, okay, well, you can genuinely start a technology business, a technology startup for about $20,000 was the figure that I heard. And I was like, hang on. Well, that's actually less than it costs to run a Demos project. So in my head, I was like, well, okay, I can stay in the think tank world and raise money to run a project where we might have a bit of influence to try and change a policy in a particular area, or potentially I can leave and try and start a startup that directly has an impact and directly has an impact for people. And that was the sort of mental flip that happened in my mind, where I was like, actually, I think I want to start something that has a direct practical implication for people and hopefully a positive impact, rather than working in policy. And so, left and didn't have an idea really about what I wanted to work on when I left, but soon started to meet other people who were interested in the same thing. I think there was a bit of a move amongst my generation at that time who were sort of looking for a bit more autonomy, and the idea that you could start a startup was new and interesting. And I had no trouble finding co-founders and people who wanted to join the journey, if you like, at that time. And we settled on adult education, so lifelong learning, as being this area where we could see it really hadn't been affected by technology at the time. It was still, in the UK anyway, in pretty old-fashioned adult education colleges. And the classrooms weren't they were pretty dilapidated. The catalogues for going and finding an evening class were, paper catalogues and so on. So what we decided to do was try and update that and bring a bit of technology to help people find people that they could learn from throughout their lives. So the shorthand for it was an eBay for adult education. So you could teach through it, you could learn through it. And we focused on face-to-face learning, so trying to coordinate and organize people in the real world rather than shifting to online learning. Because at the time, I think, video wasn't quite good enough. It was still early days of the iPhone in terms of people having smartphones and so on. So we felt like trying to organize the real world was probably the best way forward at the time. And I think we got some things right. We got some things wrong. It was a huge learning journey for me in terms of how do you lead a team, how do you create a product, how do you raise money, all those kinds of questions. And it was chaos as well in terms of.
So if I understand right, that you're really building a technology platform to give people access to where in-person learning was occurring. That
was the idea. So if you lived in a neighborhood, you could find, the local tuba teacher. Without necessarily, having to sort of find his little notice on a card in a newsagent, or just opening up that process was what we were trying to do, and trying to do obviously a lot more both group and one-to-one. To be honest, it's sort of in the name in terms of we tried to do everything, and that was one of our mistakes. We weren't focused enough, I don't think, on finding one mode of learning that really worked and one business model that really worked. We tried everything, and then 2008 hit, which made it very, very difficult to raise money to continue the growth.
You must have paid some tuition payments to the School of Hard Knocks trying to raise money during 2008 and the Great Recession.
Yeah, it was pretty galling, to be honest, because we were doing very well. We were growing sort of very well. We'd raised money from angel investors, from some really sort of well-known angel investors. But at the time, it didn't feel like the UK had a tech ecosystem that could really support those kind of high growth. But at the time, we weren't really generating much revenue type startups. It's funny looking back now because London has such a good tech investment ecosystem. But back then, you had to go to the US. And so, I was literally in New York pitching VC firms as people were walking out of Lehman Brothers with their boxes of belongings. And then I think it was a few days later, there's this sort of PowerPoint deck circulated. I think it was Sequoia. Was it Sequoia who did the RIP Good Times deck, which basically said, look, the tech boom is over, of the noughts. And we had to just completely rethink the business. And there was no way that we were going to raise serious venture capital at that point. And so we shifted to a much more business to business approach rather than direct to consumer. So we started being paid to list the information about education, which is generated some revenue, but is nowhere near as scalable a business. And so, it ended up being a moderately successful business, which we sold in 2011, but not the high growth, venture capital backed story that we set out to achieve.
So it still exists. You sold it to somebody.
Yeah, we sold it to one of our investors actually, but not for a huge amount of money. But I think that was probably the best outcome we could have got in the circumstances.
Around 2012, then you founded Bethnal Green Ventures, which is where you're at today, and of course why we're speaking today. So how did the founding of Bethnal Green Ventures come about?
There was a bit in parallel with School of Everything, which was that I used to help organize these weekend events that we called social innovation camps. And they were partly a kind of hiring tactic for School of Everything, in that they brought like interesting developers and engineers into the building where we were based. But they were also based on this thing we'd noticed, which was that really talented developers, designers, entrepreneurs wanted to work on social and environmental issues. And they weren't getting the opportunity to do that in their day jobs. So most people in tech at the time were working for banks or advertising agencies or, those kinds of companies, and actually weren't working on stuff that they really cared about. And so we gave them the opportunity at the weekend to come together and get together in little teams and try and hack together a prototype of something that might have a positive impact. And the energy around those was amazing. We ran, I think, sort of 5 of them in London. The model that we had spread to lots of other countries as well. So we found there were people running them in sort of Kazakhstan. And I had a bit more time on my hands, basically. I recognized that community of people actually were looking for somebody to help them make the first step from just having a prototype to turning that into an organization or a company. And that's where Bethnal Green Ventures came from. We thought, okay, well, we've got this community of people that we know are passionate about trying to put tech to work for social and environmental goals. What do they need? And they all said, oh, well, I need a bit of money to help me quit my job and turn it into a startup. And that's where the idea for Bethnal Green Ventures came from. Got together with a few other people, and we managed to talk Nesta, who are a foundation in the UK, into investing. I think it was about £150,000 at the time that we could invest in the companies. Google gave us a little bit of space in their offices near Old Street. Called on loads of sort of contacts who became mentors and helped the startups get going. And in 2012, we backed 6 companies during the summer, right in the middle of the Olympics that was going on in London, which was a terrible time to try and organise anything because the logistics of London were not perfect at the time. We ended up having to house all of the founders who came from outside of London. We rented a house for them for the summer. And quite a few of them ended up sharing beds, let alone sharing rooms, because there just wasn't enough space in London that summer to get everybody in. So it was great fun. And and I know, make no bones, but we got very lucky in that 2 of the 6 companies that we backed that summer became multi-million-pound businesses. So that enabled us to then to grow from there, really, and raise more money in order to back more startups that had that social and environmental goal as well as the high growth goal.
You founded Bethnal Green Ventures with an impact angle to your strategy at a time when this was highly unusual for venture capital to do this sort of thing. What did you see then that led you to build a firm to invest in it? It
was partly the talent of the founders. There were some genuinely brilliant people coming to us and saying, I don't know where else to go, because the mainstream VC world thought that what they were trying to do was charity. They thought it was it's charities that have social impact. And they were literally getting turned down saying, oh, I think you should start this as a charity. But then on the other side, the charity world was saying, oh, we can't fund businesses. We can't fund things that are going to be revenue generating. So where do I go? And I said, well, I think I might have an answer. And also, I think at that time, impact investing was still quite, I don't know how to put it. It was a bit in the helicopter position. It had been talked about in very high level forums and all this stuff, but the implementation of impact investing was still very early back in 2012. So because we were small, we were only trying to raise small amounts of money, we were able to actually put things into practice very quickly. And so I think our timing was lucky, to be honest. It felt like there was a lot of resistance to us because we were so early, and a lot of people told us we were mad, but actually that enabled us to innovate and try things in the gaps and the cracks between everything else that was going on. And we managed to certainly attract the best founders at the time because they had nowhere else to go. That's what we built from, I think. But we've always had this 2 parts of the thesis. One is that, we believe that impactful tech businesses will be the most valuable businesses of the future. We think that the companies at the top of the stock market in 10, 15 years time will be the ones that can really demonstrate they have a positive impact. And somebody's got to help start those. And that's where we come in. And then the other side is that we really believe that in diversity of founders, so that you don't just want to look for the usual suspects of sort of the tech world to create those kinds of businesses. You need real diversity of thought and background and approach in order to do that. So that's what we've ended up with, is this incredible portfolio, if you like, of companies that are driven by an ambition to have a massive positive social impact and financial gains. But they are also a really quite an unusual bunch of people, which makes it a lot of fun.
2012 was early doors for Impact, that's for sure. What was the genesis of the name Bethnal Green? Is it just based on, was your office looking there or what?
Yeah, so at the time, these social innovation camps that I mentioned, we were holding those in Bethnal Green. By this stage, we got the idea for what became Bethnal Green Ventures. And I remember a conversation where we were like, well, what's holding us back from just launching this tomorrow? And I said, well, actually, one thing is we haven't got a name for it. I said, well, okay, well, if that's just holding us back, let's come up with a name here and now. We don't leave this room until we've got a name. And we're like, well, where are we? Okay, Bethnal Green. And also at the time, there was a little bit of tongue in cheek, because at the time, you wouldn't have expected a venture capital firm to be based in Bethnal Green. At the time, the finance world in London was either in the city or it was in Mayfair. The idea of a financial services firm based in Bethnal Green was a bit of a joke. I quite liked that. And so we said, okay, let's call ourselves Bethnal Green Ventures. And so we created the website and launched it the day after. And that was that.
Can you give me a high-level introduction and overview of Bethnal Green Ventures?
Yeah, Bethnal Green Ventures, we set out to invest in and support founders who want to use technology to have a positive environmental, social impact and build high-growth companies. We don't believe it's an either or. So we're looking for companies where essentially we think of the world as a Venn diagram of, high growth, high profit and high impact. And we're looking for the intersection between the two. We don't think of it as a spectrum in that way. And our strategy is to invest in them very early. So we think that we've got a lot of experience in our team and in our networks of helping companies from pretty much day one. So when you've got founders who really understand a particular problem that they want to solve, but might not have experience of growing a company or of building a team, all those kinds of things. So we help them from pretty much day one. So usually we want to see a prototype of something that they think can turn into a product that will help people. We're almost always the first investor in. And the way that we invest is through cohorts of teams. So typically we invest in about 10 companies at the same time. We introduce all of those companies to one another. So they create a bit of a support network amongst each other. We give them access to all the materials and the networks and resources we think they might need to get them all up to the same speed and the same level of expertise in company building, if you like. And then the ones where they do find something that really meets a need and starts to show promise, then we make a further investment at that point and help them to grow. And then we fund them through to their seed round. And at that point, we start to hand them over to other investors. So that's our model. We have 3 impact themes that we're particularly interested in. So there is sustainable planet, an inclusive society, and healthy lives.
How many employees do you have?
Well, there's 7 of us in the BGV team, in the core team.
Is it one fund or do you have multiple funds?
Yeah, so we've been going for 10 years. We've had a mixture of different types of fund over that time, because we've found ourselves actually, I guess, in some ways, the biggest struggle we've had has been fundraising. It's been challenging, partly because in the early days, people thought we were mad. there was definitely an element of, can you have a venture capital fund that has an impact? That changed, I would say, around 2015, 2016. So our first fund was very much prototype, and that involved Nesta, the foundation, who were one of the LPs in that. And then they were joined by Big Society Capital, who are the main wholesale impact investment fund in the UK. And they helped us to scale that up. And then we shifted after that fund. We tried to raise a larger institutional fund at that point and failed. We couldn't get buy-in from any of the sort of common LPs into venture capital firms in the UK. They still really didn't get impact, I don't think, at that stage. So we actually switched strategy and started raising money from high net worth individuals directly. And we raised these annual funds through there's a tax relief in the UK called SEIS or EIS, which helps early stage companies to raise money from high net worth individuals. And we started raising those on an annual basis. And we've raised 5 of those over the last 5 years. And we've invested that alongside some institutional money from people like Big Society Capital. So that's been the evolution of our LP base, if you like. And we are now raising a larger institutional fund, and that it's now, I think it seems there's much more appetite from those kind of investors for impact, which means that we'll be able to scale up.
So you have multiple funds then?
We've got 7 funds that are, in the some of them are fully deployed, some of them are in the exits phase, and some of them we're still deploying.
So these are closed-ended funds then?
Actually, we have a bit of a mixture. So our first fund, because we set it up as a prototype, actually started out as an open-ended fund. However, we decided to stop investing from it a couple of years ago and shift to closed-ended funds just because they're more normal in the venture capital world. So yeah, we did have an open-ended fund, but we're now focusing on closed-ended funds.
And do you publish your AUM?
Yeah. So far we've invested about £10 million. Hopefully that's going to go up quite significantly in the next few months as we raise a new fund. But yeah, we've only invested about £10 million so far. But yeah, backed some really good companies with that.
I spoke some time back with Ben Rick at Social Sustainable Capital, and his experience has been exactly that. He was saying in the early years, they couldn't get it, they didn't understand it, and now they're calling him and he's getting a lot of interest from that. You have focused on what you call tech for good. What is tech for good? What's your fund's theory of change? And is this an approach or a process or an asset class? Help me understand this.
Yeah, so for us, tech for good is very closely linked to sort of the GIN's definition of impact investing. So we're looking for companies that are intentionally trying to use technology to have a measurable impact. So the 2 key words, intentional and measurable. So that's our definition of a tech for good startup, is one that is intentionally trying to have a positive impact in a measurable way and also deliver a return to its investors. That's our definition, if you like, of tech for good. As I say, the reason we think that makes a good investment is a very big kind of macro question. We really believe that in order to maintain trust in both technology and even to some extent capitalism, in terms of like the way that companies work, companies are going to need to demonstrate that they have a positive impact beyond just delivering a return to their shareholders. And so we believe that the big companies of the future will be the ones that do both, the ones that show both a positive return and a positive impact. And we don't really believe, looking at the stock markets of today, that the current incumbents of those markets are going to be the ones that deliver that. We think it's going to be new companies that come up. Maybe some of them will be acquired and merge and so on with other companies, but we think that there is a huge growth potential for companies that are founded at the moment to become the big companies of the future, provided that they can demonstrate that impact and obviously that financial success as well. And that's what we're trying to find. That's what we're trying to get in on those early, because it's incredibly risky. Most of them will fail. But we think that if we can build a large enough portfolio, so if we can diversify ourselves enough, then a handful of them will become those big companies of the future. And that's basically the thesis behind BGV.
What's your theory of change?
The theory of change is that by providing capital to motivated founders, motivated and I guess like capable founders, that we can essentially change the idea of what a tech startup is. That's really what we're trying to do. So we're trying to make it incredibly desirable and positive attribute of startups that they should have a positive and measurable impact as well. And we stand to benefit, obviously, from that if we're the investors in them. But we're also fine with loads of other people doing it as well. If a lot of other investors start to do tech for good investing as well, that's also very positive in terms of our theory of change. We're trying to change the whole of the early stage tech market. I wouldn't claim that we're responsible for all the change, but it definitely has changed over the last 5 years. The number of new funds that are trying to do impact tech or tech for good, the number of mainstream funds that have hired people or that have added impact and tech for good to their strategies is brilliant. We think that's all great. And the more the merrier as far as we're concerned. So that is also part of our theory of change as well, is that if we can make it more desirable, we can make it seem more attractive, we can show that you can have success by backing these kinds of startups, then we change the whole of the early stage tech market, which moves, hopefully in the end delivers greater positive impact for society and for the planet as well.
How should I think about tech for good? Is it a sector, or is it an approach, or is it more about the founder's intentions?
I think it's an approach. I think we would describe tech for good as an approach. It's very entwined with the founders because it's the set of questions you ask yourself when you're creating a business, which is automatically incumbent on the founders. So what's the problem we're trying to solve? We have a particular methodology for unpacking problems, so it's at different levels, in order to make it addressable by startups. And that's an approach, if you like. So the way that we unpack the social or environmental problem that they're trying to solve, that's part of the approach that we expect from our startups. I don't think it's a sector because it sort of transcends other sectors. So it makes it difficult to call it a sector in and of itself. We have healthcare startups, we have, climate change startups. But then having said that, I wouldn't say that all healthcare startups are tech for good startups. For example, I think you can get healthcare startups where actually you're not necessarily trying to solve a particular sort of social problem. You're just, you potentially could reinforce existing social problems or social inequalities through backing that kind of startup. So I think it's an approach rather than a sector on its own.
Most people are fairly familiar with venture capital and the concept, but what you're doing is different. So how does impact venture capital investing differ from other types of impact investing?
Yeah, I think, I'm sort of good friends with a lot of people who would describe themselves as impact investors, but in very different asset classes to what we do. And I think one of the things that we often find ourselves talking about is the impact that we can have as investors as well. So there's obviously, as an impact investor, you can invest in impactful companies, but you can also have an impact yourself on those companies. And certainly some friends I have who, let's say, are doing impact investing, but let's say in public markets, they're a little bit jealous of what we do at BGV because we have such a direct interaction with the companies that we work with. We're so able to get involved as their strategy is formed and as they put in place their impact management and their impact measurement and all those kinds of things. We're so able to have an impact on the companies themselves. That's one of the things that I think makes impact VC quite different from a lot of other forms of impact investing, is just the directness of the interaction that we have with those companies. And that's, I really enjoy that. I think that's, I probably wouldn't do it if we didn't have that, to be honest. I'm not sure I'd be a great investor in sort of public markets and that kind of thing, because I'd get frustrated at the inability to actually help those companies get better. That's a big part of what makes impact VC different.
I guess maybe the confusion comes in that there's a lot of investments out there that have the impact label.
I think that the definition of impact investing, certainly in the UK, is firming up, I would say. It feels much clearer to me now than it was even sort of 2 or 3 years ago, around this idea of intentionality and measurability, basically. So there's, and it's creating quite a useful contrast with ESG as well. So I think we're starting to see like a clearer division between what's ESG, what can you consider to be, you know, an ESG fund, if you like, and what can you consider to be an impact fund. I think those two things are starting to separate, whereas a few years ago, there was all kinds of like sort of muddiness almost around what was what. And yeah, I think ESG is certainly being seen as more like kind of process driven. It's more about risk management and all those kinds of things. Whereas impact is more like investing for a positive outcome or a positive measurable impact. And that's quite clear now, I think, certainly not in the sort of general public, but in the financial services world, it's becoming clearer that, and actually even by the regulator as well. So I think it's quite likely that the FCA in the UK they're about to announce their sustainability disclosure regime, and it's quite likely that they're going to make a division between the two as well. So there'll be a if you claim that you are going to create a fund or you're going to have a fund that has impact in the name, then it does have to go above and beyond what we commonly understand as sort of an ESG fund. And I think that's a good thing.
Are you typically making equity investments or debt and equity?
Yeah, so we're predominantly equity investments. If we do debt, it's usually convertible debt. And it's for reasons of being, needing to be a convertible note for sort of just practical reasons at whatever stage it is. But yeah, no, we're very much equity investors. We even if we're using debt, we're thinking of it as equity. And
do you have target returns that you communicate to your investors? And if so, what are they?
All of our funds, roughly speaking, target a 20% IRR. So that's essentially means we're looking to provide kind of 2 to 3 times people's money back, but over a 10-year period. And the performance of our first fund is in line with that. Yeah, that's part of the reason for being able to sort of say that. And I think we've learned, certainly by, talking to and seeing a lot of benchmarking sort of more mainstream venture capital funds, that's no different to most European early stage VC. So we certainly don't think there needs to be a lower return because we're tech for good VC firm or an impact VC firm. And actually, I think it's very hard because there's not enough of us yet to have proper benchmarks. But certainly, my feeling is there's not many sort of poorly performing impact VC firms at the moment. So I think the balance of the impact VC firms does seem to be towards the better performing ones, but it's still early days, so it's very hard to be able to say that for sure. But I think there's a lot of thought goes into designing impact funds because you have a lot more information to think about. And I think that leads you to actually have very well run firms. That's not going to be the case all the time. I'm sure there'll be some bad ones that come along and some people who say they're impact and aren't and just don't do it well. But at the moment, I think there's a really good cadre of impactful VC firms that have been set up over the last few years in Europe, which I think is very positive for the future.
Can you describe your exit strategy? How do you approach your investment exits?
When we set up, I think we assumed that our exits would be trade acquisitions. So, our companies being acquired by larger companies. And that has certainly been the case in several of our exits. The thing we didn't predict, which has been the case with a couple, is essentially very successful secondary transactions where later stage investors have come in to become investors in our companies at, let's say, Series B, Series C, and they've wanted to acquire the shares of the early investors as well. So they're still got, they're still backed by investors rather than being wholly acquired, but those investors have bought out the shares of the early investors for a good return in our case. So we're seeing a mixture of acquisitions and secondaries as our exit at the moment, and hopefully in the future we'll do IPOs as well. But yeah, so far we've seen a mixture of acquisitions and secondaries.
And what do you do to make sure you're investing in businesses whose impact can be preserved after you have exited? Because that's the point of it all, isn't it?
For us, that's about linking the business model to the impact. So if the business model, so the engine, if you like, of economic value is linked to having a positive impact. So effectively, if the company more impact every time it sells a unit of its product or service, then that's very positive. And it means it's very likely that that impact will be preserved after an acquisition, because usually in an acquisition, the thing that is being bought is that economic engine. And so that's one of the reasons why we spend a lot of time in the early days trying to help founders to link their business model to their impact, and making sure that the two are aligned. Partly because we found that that's the best way of preserving, the impact should they be acquired by another company.
How do you screen your deals? What is your due diligence process that gets you to the point of pulling the trigger? Because you're investing in businesses at very early stages. So can you walk me through that?
So the way we do it is being very public about it, essentially. So twice a year, we open up a call for applications, we call it. And typically we have hundreds and hundreds of small teams who apply to us for investment. Last one, I think we had 300 or so ventures who applied for us, and we choose about 10 of those. So it's a very competitive process. So that's the first step, is to make sure that we've got a very large number of people that we can essentially choose the 10 best, if you like. And the way we do that is people apply online. Then we use our community, our network, so the BGV team, but also our mentors and some of our previous portfolio founders as well, to shortlist down those 300 and to score them against a variety of criteria, which are things like, the potential for impact, the potential of the business model, the potential of a team. That gives us a group of, let's say, about 50 companies, and we interview all of those teams. And there we're looking much more at the team. So that, that's very much about the quality of the entrepreneurial quality of the team. Do they have a really good mix of skills and mix of approaches in that founding team? It's rare for us to back sole founders, as they tend to be called. It's typically we're backing teams of 2 or 3 people. And after that interview, which also includes some of our portfolio founders, some of our mentors. So we've always got people that we can bounce ideas off as the BGV team in terms of thinking about these teams. Again, we score them mainly on the team at that stage. And then we make offers to roughly speaking, the top 10. And when you do that, like every 6 months, which is what we do, you start to see some patterns. You start to sort of get the warning signs, if you like, of things that don't work. I mean, we've backed over 170 companies now over the last 10 years. So, and screened thousands and thousands of them. So you learn these tells, if you like, of like what makes a good team, what makes a good product. And I think one of the most important things for us is, can the team teach us something about the problem that they're trying to solve? So do they tell us something we don't know about the problem? So do they have a unique insight into what people who face that problem are going through, or the way a particular industry is failing to tackle a particular environmental issue, or that kind of thing? So that's a very good indicator for us, is if they can teach us something about the problem they're trying to solve. That's often a very good sign that they've got something unique that hopefully, you obviously have to look at it, but that could grow into a really successful business.
Right. Is there any particular angle in terms of technology?
We're fairly technology agnostic, actually. I think we like to be convinced by the team that they've chosen and thought about the technology that they're using in an appropriate way. So we want them to be able to prove to us that the technology they're suggesting as a solution is the right one. So we don't automatically think, oh, I'm sure AI could solve this, or, I'm sure this should be a hardware startup. Again, we're led by the understanding of the team about the problem as to whether the technology is a right fit. Having said that, we are to some extent a bit limited because we make very small investments. We don't have hundreds of millions of dollars to invest in these companies. That really limits the profile of the technology that we can back. So hardware, usually there's certain kinds of hardware that we can back with our profile of capital, but it's a small fraction of the startups we back are hardware, to be honest. And then likewise, there's also the time scale of the technology. So if you're talking about medical devices, for example, that just the time it takes to get all of the approvals you need means that we've probably not got enough capital to back a company like through all of those stages. So there are limitations on what we can back, but they're generally driven by the amount of capital that we've got to invest.
Can you give me 1 or 2 examples of investments that your fund has made that demonstrates the type of investments that you prefer to make and make everything you just explained to me real now? What was the impact outcome that was achieved? And if you've exited, what was the financial result?
Maybe I'll take one from each of our impact themes, if you like. So in A Sustainable Planet, a company that we backed actually back in 2013 is called Piclo, Piclo. And they came up with this idea of what's now known as a flexibility marketplace for energy. So that's essentially software that enables energy grid providers to buy, sell, and operate supply, demand, and storage at the same time. Now, they came to us with this just amazing understanding of like how poorly set up electricity grids were for a renewable future, and intermittency and all of the problems around, like, you know, when the wind blows and all those kinds of things. And they were very convincing on like this is an industry that really needs new technology in order to make this transition. And without that technology, it's just the energy transition is impossible. I think one of the things that we learned through backing them was that actually it takes a long time to convince the industry of that as well. You know, it was the first investment I think we'd made that was deep in the energy industry. And part of what that team has had to do is actually almost like a sort of lobbying and kind of government affairs type approach to changing the industry, so as they got the urgency of the solution. Now that has worked. So, you know, we're nearly 10 years on, and now they are the primary supplier of flexibility services, flexibility marketplaces in the UK. They've just opened up in Italy. They're just opening up in the US. They've just got their first customer in New York State. So they are fundamentally enabling the transition to renewables in like developed electricity markets. And we think that's super, super important. And we haven't exited that business. We're still very much involved, but they're really, really, really showing, I think, amazing potential for technology to help with the transition to renewables.
That's a great story. You have two more, you said?
Yeah. So in an inclusive society, there's a company called Organize. They came to us sort of basically showing just how many people were essentially dissatisfied with work. It sounds a bit sort of pessimistic, doesn't it? That actually there's this issue of like there are like lots and lots of problems essentially with mainstream like frontline work, whether that's in retail, hospitality, warehousing, logistics, all those kinds of things. And they said, well, actually, like you could improve these jobs by surfacing those issues in a way that helped them to change. And so what they created with Organize was essentially a workplace campaigning tool. So enabling people to find other co-workers who had the same issue as them, and then collectively get together and essentially like raise that issue, approach management or whoever was most relevant, and try and get it changed. And, you know, this is in an era where I think we do have like some significant barriers to trade unions in the UK. I mean, there's some of that is just structural. Some of it is like the rise of the gig economy and the fact that those are not unionized sectors and so on. So they really hit a zeitgeist, and they grew actually particularly during the pandemic. They've now got over 1.5 million members in the UK, which is like, that's a significant proportion of the UK workforce who are using Organize to raise these issues and hopefully, and to improve workplaces. And it's really, really interesting company. Interesting also, like, you know, led by two women, which is unusual for a tech startup, and especially one that's in that kind of future of work space. So they're just starting to look at expanding to the US as well. So they're an interesting company in our inclusive society theme. And then in Healthy Lives, obviously in a really interesting position in the UK with because we've got the NHS, and that makes like being a tech startup dealing with health in the UK quite unique. One of our earliest investments there was a company called Dr. Doctor. Maybe there's an interesting naming sort of story there, but but they came to us as just really understanding the problems of like health administration inside the NHS and how the paperwork did or mainly didn't work around appointments. And they said, look, we've got to be able to use technology to prioritize and to organize the way that appointments in hospitals are done so as they're better, so as it's more efficient, and people understand what's going on. There was, it got to a crazy point where it was costing hundreds of pounds to just send a letter to somebody to tell them when their appointment was, and they might not turn up. And they've built this really fantastic technology that both works for the NHS staff, but also works for patients. And they're now used by 25% of the hospitals in the NHS. And I think, I've saved the NHS millions and millions and millions of pounds. They're another story of quite a unique story because of the way the NHS works. But they really understood the problem, and now, are seeing real financial success because of that.
What is your average ticket size that you put into these companies?
So when we first started investing, our first investment was £15,000. So, that's grown to be more recently £30,000. And we're just about to increase it again to £60,000. And that's really a reflection of actually confidence to some extent of the companies are coming to us slightly better formed, if you like, as time goes on. But our first investment is a few tens of thousands of pounds. And we're very deliberately, that's about helping that team to try things out. And then if those things start to really show promise, then we'll invest a bigger ticket. That first investment is a few tens of thousands of pounds.
And do you have co-investors?
Not for the first investment. The first investment we almost always do on our own, and we're certainly not dependent. We don't wait until other people join. The follow-on investments, almost always we're doing that with other investors as well, whether that's angel investors or other funds.
So you are essentially family and friends investors for founders who have no family nor friends.
Yeah, it's a very good way of putting it. And the venture capital business has huge problems with diversity. And I think when you look at our portfolio, it is much, much more diverse than most portfolios of venture capital firms in Europe. And part of that, I think, is the fact that we go so early, the fact that we're able to be that kind of friends and family round for people who don't necessarily have friends and family. And so, we've very deliberately gone out to try and find diverse founders, but our model helps us with that because we're able to put that money in where, maybe slightly more usual suspects would get that money from, sort of wealthy friends and family.
I've had Sharon Bosmick of Astia on the show, and she's, of course, very focused on women-led VC and startups, but she doesn't mince any words about the lack of diversity in the venture capital.
It's terrible. It's absolutely terrible. And we're at BGV, we're a majority female team, and we've got very good representation of ethnic minorities and so on in our team and in our community and so on. So it's quite deliberate that we're trying to sort of have a diverse team, have a diverse portfolio, because we believe that will drive better outcomes, both from an impact perspective and from a financial perspective. But it does make us quite unusual. I think often founders come to us and go, "Whoa, hang on, this is a bit different," because still the norm in European VC is, well, to be honest, it is people who look a bit like me, but it's it's all people who look like me rather than I am absolutely the minority at BGV.
But how do you think about measuring and managing the impact outcomes, especially of an early stage business when so much of the potential impact is unknown and is somewhere out there in the future? How do you think about measuring and managing that?
So we quite led by the what used to be called the Impact Management Project, which was created in London, kind of offshoot of Bridges Fund Management, and they have these dimensions of impact, if you like. It's a very useful framework. It's what we like about it is it's actually quite flexible, so it works across sectors, it works across stages, and so on. And that's our general framework for impact management and measurement. Within that, we particularly focus at the early stages on helping founders to create a theory of change and then to create a business model that is linked to impact. So at this stage, they don't have any impact. It is all hypothetical. We're helping them to create the business and the product in the first place. And I guess we've just learnt various sort of know-how and tricks and tips for making sure that that's done in a way that's not going to come back and bite you later, which I think is part of like what we're trying to do at the early stages. And really what it is like helping them to set metrics that are simple, that are helpful to them, but that will also be helpful in demonstrating their impact to the outside world. So that's things like, if they say, well, we want to measure this because that is the link to our business model. And we say, well, you might want to tweak it just this little bit because that's actually in this database that, of say Iris, which is a database of, impact metrics. And so you can standardize it. So a lot of our work is helping them set up those processes and systems in a way that is going to be compatible with the outside world. And then we think about it in terms of what we call standards of evidence. So those very early stage companies, we don't expect them to have much data yet. We just expect them to have a theory of change and some metrics that they're going to measure. But as they progress, we want them to collect data and they have to report that to us on a quarterly basis around their impact. And we expect the standard of evidence of that impact to go up as they grow and as they raise more money, as they get more customers and as their team grows. And Nesta created this framework called standards of evidence, which goes between level 1 and level 5. And we found that some people certainly thought that, BGV companies would have what they tend to call mission drift. So as they get bigger, they'll care less about impact. What we found is actually the opposite. So as our companies grow, so by the time they're at Series A, which is, they're raising institutional capital, we found that the standard of evidence is almost always level 5. So like they are getting better as they grow at measuring their impact, and they're getting external validation, independent evaluation, all those kinds of things. They all kind of come in over time. So we're quite pleased that by working with them on impact at that early stage, we seem to be setting them up to get better at impact as they grow. And that's pretty good.
Do you see impact washing? I mean, is this even a thing in the VC space?
Yeah, I think we see people, not really in the BGV kind of tight community of like a portfolio and or companies that are close to us, but we've definitely seen companies who've sort of claimed to be impactful where really it's just an add-on, if you like. And that's fine. I'm not necessarily against that, but it's not what we do at BGV. For us, the two have got to be linked. They've got to be, a whole, if you like. There's got to be impact and growth all in the same engine. We're not interested in companies that essentially have a business model that makes loads of money and then a sort of foundation that gives that money away to have an impact. That's not us. I'm not saying that's wrong, but that's, that we've definitely seen some of that going on.
VCs are sometimes criticized for their focus on growth rather than on underlying financial metrics like profitability. And with the argument, particularly within impact investing, being that impactful businesses often have to dilute their impact in order to target unicorn style growth. Do you think there's a tension between venture capital model of equity investing and creating enduring, sustainable impact businesses?
Yes, there can be. I think the truth is that there isn't really one venture capital model anymore as well. I think that there is the unicorn model of venture capital, but that is only one model. Venture capital is much, much bigger than it used to be. There's lots of different funds with different underlying economics. We actually don't, when we model out our funds, we don't expect unicorns. We expect still very valuable businesses. We expect businesses that are worth like 100 million, but not necessarily a billion. And that's what our experience has tended to be that tech for good, impactful businesses on the whole tend to prefer slightly more sustainable business models than just like hockey stick, no revenue business models. It's actually very rare that we get anybody come to us pitching us something that's like, we need to just grow at all costs and then find a business model. It's very, very rare. There tends to be something about, I think, impactful mission-led businesses that they want to prove that they can make money a bit earlier in their life cycle, maybe. I'm not sure what it is, but when you look at the sort of economics of BGV portfolio companies, they tend to be generating like pretty significant revenues, maybe a bit earlier than some other like sort of non-impact companies that are just going for growth at all costs. So And I think that makes them more resilient as well. So it's quite helpful from our point of view that the portfolio is less erratic, if you like, in its value as well. So yeah, I think there can be a tension, but it's a bit more complicated than that, because I don't think there is such a thing as just one venture capital model anymore. I think there are multiple models of venture capital, and they can all coexist quite happily.
Who are your fund's typical investors, and why are they investing with you? Is it out of passion or mission or returns, or maybe it doesn't matter?
It's a mixture. It's definitely a mixture. I think of the sort of high net worth individuals who've invested with us, they're roughly speaking a half people who work in financial services who've got an interest in kind of impact, and half successful entrepreneurs who, some of them do to the language of they want to give back, or they want to see more tech for good startups and so on. So yeah, that's the breakdown of our individual investors. Our institutional investors to date have definitely all been sort of organizations and firms who think that impact investing is very important in and of itself. So all of them have an impact strategy, if you see what I mean. I don't think we've had any investors who've not at least understood the impact nature of what we do, if you see what I mean. I don't think it really appeals to people who don't get impact, if you like. So all of our investors are very much aligned with what we're trying to do and trying to maximize both returns and impact.
And are individual investors 50% or 80% of your fund?
No, they're probably more like 25% actually at the moment, I would say, of our AUM.
And the rest are more on the institutional side?
Yeah.
And I suppose I think you've alluded that's changed over time, right? It was all individual at the beginning.
Yeah. So it shifts over time. And I think as we scale as a company, it will change again, I'm sure.
So everything you're doing, of course, no one's going to argue with this. This is a much better model of capitalism. But are there downsides and risks that are unique to your investors versus an investor who's investing in a traditional non-impact focused venture capital fund?
That's a good question. I mean, I think the way it is incredibly risky. Like most of our companies fail. That we don't pretend anything otherwise, because we're investing at such an early stage. Way more than 50% usually of any investments we make at that really early stage in a year, more than 50% of them will have failed within a couple of years. But the upside on the ones that really work, completely outweighs all of the downside risk of those individuals. So the risk is basically, do the good companies, is there anything that could wipe them out? So that's more like kind of looking at the external risk in the world. So that's the reason why we diversify across the impact theme. So we're quite general, if you see what I mean, deliberately. We think if we were too focused on one impact area, we think the risk of the good ones being wiped out is higher. So that's why we're across different impact themes. We're also across different business models. So we have a mixture of business to business startups, business to consumer startups, and business to government startups. And again, that's for diversification. It's because if there was, an economic change that meant that all business to consumer startups suddenly suffered, we don't want that to wipe out our good ones. So for us, the answer to the risk question, which we don't shy away from, is diversification. It's making sure that of the companies where it really does start to motor and really start to work, that there's not external things that can just take them out and mean that we don't have a return for our investors. So that's our way of managing portfolio risk.
What do you see as the role of artificial intelligence within your tech for good paradigm? And are you investing at all in AI? And if so, where?
We've invested in, sort of machine learning AI for 6 or 7 years. And actually one of our early exits was a machine learning startup that was about recognizing how healthy food was from photos. And that was back in 2015, I think. So we've always been sort of interested and involved in AI and machine learning. I think the kind of generative AI side of things, so the wave that we've seen more recently, we're a little bit more skeptical of, I have to admit, partly because we don't have the capital to play in the really big side of that in terms of you need hundreds of millions of dollars to train models and all that kind of thing. So that's not really our bag. I think we're interested in specific applications where AI, if you like, is the best solution to a particular social or environmental problem. But actually what we've seen so far is that's still only true in a relatively small number of cases. There are often better technologies or cheaper technologies or more appropriate technologies to solve those. So we're not complete cheerleaders for AI. We don't think everything has to be AI. I do think it's going to have a slow effect on everything, on all businesses. But in terms of just investing in AI startups, that's at the moment, that's not something that we don't think that's a particular opportunity as opposed to any other technology.
I mean, on the one hand, AI has great potential to create impact by rolling out services cheaply that would have been inaccessible to many people. Some examples might be financial or legal advice to people on low incomes. On the other hand, the automation of more of the economy could bring real negative impact to people and jobs that can be automated at all levels of the economy. And then, thirdly, there's the potential for AI to be used for harm by malicious actors, which we can't really ignore that either. But do you have a framework for thinking about how AI can be used for positive impact, but in a way that minimizes these type of impact risks?
Yeah, so actually, I perhaps should have talked about that in our sort of impact management side. So one of the things that we try to equip all of our ventures with as well is ways of thinking about unintended consequences. With all of our startups, we take them through an exercise quite early on, which is to help them think about what are the potential negative implications of what they're doing as well. So it's not just about measuring the positive, but regularly revisiting what could be the negative implications of the technology of the product or service that we're creating. And we try to get them into the habit of doing that because we think it's a very important, regular check-in to have with yourself as a company. And actually, we've sort of seen some fruit with that. With some of our later stage portfolio companies, partly because of the rise of AI, in the media and more broadly, have applied AI to their products. Even so, they've already got a good, big user base, and now they're sort of trying AI products with that user base. I've been really impressed actually by the founders. They've done that with care. They've not said, okay, we're just going to roll it out and fire all of the people who used to do that. That just hasn't happened. We've seen people genuinely think through the implications of that. And in some cases, they've taken it further than in others. But I think the thought process and the thinking about what's the impact of that, I've been really impressed by the founders who are slightly later stage in our portfolio and the way that they've done that. When it comes to the kind of cataclysmic implications of AI, I'm personally not a big believer that those are sort of emergency, immediate, we're all doomed tomorrow situations. That I spend a lot of time with technology. I've got a lot of friends who work in the sort of cutting edge of AI in big companies and startups. There's a great piece by the sci-fi novel Ted Chiang, who wrote Arrival, the sci-fi novel. He sort of says, just whenever you hear artificial intelligence, replace that with the phrase applied statistics, because that's really what's going on. It's much more simple than the language would let on. And there are ways of dealing with the outcomes of mathematical equations that you can put them in context, all those kinds of things. So I think there is a real gradual threat of the impact of AI on things like labor markets, on what we spend our time doing, all those kinds of things. But I'm not a big believer that we're sort of in the cataclysmic next week version of AI doom. So I personally don't worry too much about those implications of us, being involved in AI.
So let me ask you, Silicon Valley's obviously been a huge driver of global technological change. You focus on the European tech ecosystem. So what does Europe have that Silicon Valley doesn't?
I'm a big fan of both, so I'm not going to say like one is necessarily better than the other. But one thing I've certainly noticed is there's a slightly different mindset, particularly I think actually to what we do in terms of tech for good. And again, I'm generalizing here, so you have to be a little bit careful because I think there are people who believe both on both sides of the Atlantic. But there's more of a default to essentially make loads of money through a startup and then do good afterwards through some form of philanthropy. In the US, there's more of a division, if you like, between good and like startup or investing in the US than you find in Europe. I think you see more people with more desire, if you like, to try and create the overlap of the two, so that I'm going to do good and do well at the same time, rather than doing well and then doing good. That mindset, again, it's a rash generalization, but I think when you look at the two different ecosystems, there is a bit of difference. So I think in some ways it's easier to do what we do in Europe than it would be in Silicon Valley. Having said that, I'm sure there are great impact investing firms in Silicon Valley, but I think that mindset-wise, it is slightly easier to do what we do in Europe.
Are there any sectors or themes that you're particularly optimistic about over the coming years?
I think we've got to a stage with investing in health where there is like real appetite for innovation now. Just having watched that for the last 10 years, when we first started investing, there was basically outright resistance from like the NHS and the players in the healthcare system. That changed, I think, partly in the run up to the pandemic, and then the pandemic probably changed it forever as people started to just have to reach for new innovations to try and solve problems very quickly. So although there are all kinds of problems and barriers there, I'm pretty optimistic actually about that the technology will have a very positive impact on healthcare systems, particularly in Europe. So yeah, that's an area that I'm super optimistic about.
If you had to name the single most important challenge in the impact venture capital space at this time, what would it be?
Fundraising is the one word answer. But that, I think we've still got a big challenge in convincing traditional LPs in venture capital that impact venture capital is something that they should be backing.
And what do you know now about impact venture capital investing that you wish you knew when you started, which you've been doing this in one form or another since around 2008?
Oh, that's a really good question. It sounds obvious, but like things take longer than you think they would. And so I think that the thing that I've learned really is actually that startups that are pushing the boundaries often need to take a larger group of stakeholders with them than you expect. Piccolo was one example that I gave around the energy markets, but then another one which we can talk about is Fairphone, who created a more ethical and environmentally sustainable smartphone. And actually having to take the whole consumer electronics industry with you is quite a challenge. But the techniques for doing that, I think, I've learned a lot about.
Can you describe to me an example of a deal that you were convinced of at the time you invested, that it ticked all of your impact boxes, but in the end, it didn't turn out, it went pear-shaped, and what did you learn from that experience?
There's probably a group of startups, and this is probably a bad thing because I think I've made this mistake more than once. In terms of but I'm still convinced that there is scope in this space, but essentially companies to help with elder care. So I think it's an area that is under real financial challenges, particularly for people who maybe don't have the resources to spend on expensive elder care. It's incredibly untouched by technology, but I do believe that technology could really help. But yeah, there's a number of times we've tried backing startups that are trying to have a positive impact in that space, but always struggled to really try and find a business model for it. And I think that's one where actually maybe I have to admit that until there is government changes or regulatory changes, we're not going to be able to back a startup that really is able to thrive in that sector.
So what was the lesson learned?
The financial system around elder care is broken in the UK. Just almost impossible, I think, they make it very difficult to help.
Now, the converse of that, can you describe an investment that you had some level of skepticism and in the end it turned out way better than you thought and you were pleased you invested, or if you had passed on it, you wished you hadn't? And what was the lesson learned from that one?
Well, actually, I think when we invested in Fairphone, which was back in 2012, they were one of our first investments and we were their first external investor. Certainly a large number of people involved in the decision thought we were mad because, they were saying, and this was at a time when there was basically only Apple, Samsung, Nokia, Ericsson were the only people who were making mobile phones, BlackBerry, of course, obviously. And Fairphone came in and said, we want to start a new mobile phone manufacturing company and we want to do that with your £15,000. Now, on paper, that sounds completely crazy. I remember ringing up a friend who was working at Nokia at the time and saying, like, what do you think of this idea? He said, absolutely no way. But there was something in it. We knew there was something. There was a big problem to solve there, and so we backed them. And then in the first couple of months that we worked with them, we essentially sort of found this idea of what we now call crowdfunding. And the Fairphone team launched the phone without having built it. And they pre-sold phones on the basis that if we get enough support for this phone, we'll then go out and make it. And the other thing I think they did that was very clever was they said, actually, we're not going to make it completely fair or completely environmentally sound from day one. We're going to try and focus on one or two things and make those fair. And then with subsequent phones, we'll improve that. And it took them several years. There's been all kinds of ups and downs on the journey, but they now sell hundreds of thousands of phones. They've been discussed. We know they've been discussed at the board level of like some of the really massive consumer electronics companies. I think they've had a huge positive impact, and they're a fantastic success story for kind of ethical tech and tech for good. And we did actually exit our shareholding from them earlier this year, and we made a very, very good return.
What was your lesson learned?
In that one, it was like, don't necessarily believe everything that people in the industry tell you. Maybe, that it's almost the opposite to the elder care one, that if there are signs of change, maybe trust the signs of change rather than what people in the industry think. I don't think the big mobile phone companies saw coming like what has changed around, like the pressure on them to be more environmentally sound and ethical and so on. So
if someone wants to get into the tech for good entrepreneurship space or the venture capital impact investing space, how would you advise them to get into the business?
If you want to start a business, want to take the entrepreneurial route in, I would definitely say like really understand a particular problem where you can have an impact. So I think we're not alone as early stage impact investors in that's what we need the founders to bring that to us. We need them to show us that they really understand a problem in a way that nobody else does. So I would spend your time like talking to potential customers, talking to potential users of the product or service that you want to build, and really understanding their day-to-day struggles and what would positively impact that. And then go from there to thinking about what's the product that solves those, and then think about, okay, well, where do I raise money in order to develop that? So do it in that order rather than trying to raise money first and then trying to think what problem I want to solve. To get into the actual venture capital business, I think I personally, I'm a bit down on the idea that there's one route in. And traditionally in venture capital, there has basically been one route in, which is essentially like, investment banking, MBA, like sort of that route in. I don't think that's been that helpful for the industry for lots of reasons. And so actually I'm more pro people like coming with their own story about how they think they can help startups. Personally, I don't think it's a big surprise that some of the most successful like venture capitalists in Silicon Valley, Mike Moritz and so on, were journalists. They didn't do MBAs. They didn't like do investment banking. They learned to like talk to people, understand their story and see where that story might be able to go and ask good questions, basically. And I think that's just one example of like a different background that can be incredibly valuable to investing. That's not what we've sort of come to see as the traditional way into venture capital, which is unfortunately has tended to be either, investment banking, management consultancy, and MBA.
And what soft and hard skills do you think are the most important for a successful venture over the next decade?
So for a venture, I think the most successful businesses will be ones that build really ethical, inclusive, but ambitious cultures. So I think the leaders and the people who've got the ability to essentially build those kinds of cultures of organizations will be the most successful. And that means like not being dictatorial, not being like, the sort of, it can't just like come from the top. It's got to come from the whole organization. And the people who've got that talent for leading people in such a way that they have agency, but they also do that in an ethical and ambitious but creative way. I think those are the kinds of startup founders who are going to thrive over the next decade. And that will include understanding things like diversity of thought and diversity of background and inclusion, as well as, how do you motivate people through mission?
Well, Paul, I think we're there. We got to the finish line. Huh? It was really great talking to you. Thanks very much, my friend, for taking me through all this. I really appreciate it. You have some amazing stories to tell.
Well, thanks very much for having me.
Yeah. Now tell everybody your websites and your social and all that good stuff.
Well, you can always find us at www.bethnalgreenventures.com. And then I think LinkedIn has actually become the most sort of popular social channel for us to talk to people. So if you just search for Bethnal Green Ventures on LinkedIn, you'll find us pretty easily.
And what's the best way for people to contact you?
For people to just email me directly, I'm Paul at bethnalgreenventures.com.
Okay. Well, thank you very much, Paul. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.